iFabric Corp beat revenue expectations, but they missed on EPS. Let's look at the hard data you shared with us today. Revenue hit $9.59 million, or about 9.6 million Canadian dollars. That is up 65% year over year, just completely crushing the 8.1 million consensus.
Yeah, but then you get to the bottom line, right? EPS came in at roughly 7/10 of a cent, so, well, they missed the 1 cent estimate. And as for guidance, they didn't give formal numerical targets, but management did note Q4 will be their largest quarter.
Right, and didn't they say their current capital can support well over 100 million CAD in revenue?
They did, yeah.
Mm.
But despite that, the stock reaction was brutal. Shares took a hit, dropping almost 11% in the pre-market down to $4.65, and they eventually settled in that $4.50 to $4.66 range.
Okay, so it kind of reminds me of a sports team scoring record points, like just dominating the field, but they still lose the game because of technical penalties.
That is actually a great way to put it.
So for this deep dive, we really need to figure out, is the market just hyper-focusing on those penalties, the EPS miss, while completely ignoring the massive winning streak?
Well, those penalties you mentioned, they tie directly into the income statement. The EPS miss is deeply connected to a really specific and honestly frustrating gross margin contraction.
Okay, lay it out for me. What happened?
So in the notes you sent, you can see their gross margins drop from 37% down to 30%. That is what's dragging down the EPS.
But wait, was that a sudden operational failure or something?
Actually, no. It was primarily driven by accounting rules, specifically IFRS requirements. They basically had to take a $650,000 CAD deduction for customer advertising support.
Hold on, so they're paying major retailers to market their products, and the accounting standard just erases that from the margins. How does that work?
Exactly. Under IFRS rules, you can't just log that as a standard marketing expense. You are required to deduct that cost directly out of your top-line revenue, so it comes right off the top.
Oh, wow. That's harsh. So if you strip away that specific accounting quirk, where do their margins actually sit?
Without that deduction, their adjusted gross margins were hovering right near their target at 36.8%. So, the underlying business is actually thriving.
I mean, the growth is undeniably there. If you look at the segments, Intelligent Fabrics rocketed 94% to 6.3 million CAD.
Yeah, and that was fueled by their new medical scrubs and footwear programs.
Right, and it's not just the tech fabric side. Intimate apparel grew 28%, hitting 3.2 million, largely thanks to the launch of their proprietary nudish brand.
But here's the thing, management is not just accepting that $650,000 deduction as a cost of doing business. They are pivoting. To stop that margin leak, they're planning to bring marketing in-house.
Wait, I have to push back here. They want to bring marketing in-house. I mean, they're fundamentally a back-end textile technology company, not an ad agency.
Right, I know.
Isn't that a massive execution risk? Like, if they misfire on those internal campaigns, couldn't that pressure margins in a totally different way?
Oh, it is a very real execution risk that retail investors need to monitor closely. It is a completely different skill set. Now, they did highlight the Target Scrubs launch as a successful example of doing highly targeted ads themselves.
Sure, but still.
And they do have the capital to try it right now. They fortified their balance sheet with a 21 million CAD equity raise in June, leaving them with 25 million in cash. Plus, they just secured a U.S. tariff recovery of nearly $1 million.
But having capital doesn't guarantee your marketing will actually convert. And looking at your notes, it seems like there are massive hurdles on the physical retail side, too. I see they want to expand their Walmart Scrubs program from 1,400 to a potential 4,800 stores.
Yeah, which sounds amazing on paper.
But what's the catch? Physical retail is a zero-sum game.
The catch is shelf space. That expansion depends heavily on Walmart clearing out a huge glut of legacy inventory from a prior supplier. You can't just put new iFabric scrubs on the floor if the old racks are still full of unsold stuff from someone else.
So they are entirely at the mercy of the retailer's clearing pace.
Exactly. They are in this classic, really painful transitional phase. They are scaling rapidly, but the growing pains of fighting for big box retail space and paying the toll to play there are highly visible.
It's the ultimate test of their new strategy. Can they transition from a back-end tech provider into a direct retail powerhouse without just bleeding out on the way?
That's a huge question.
Which leaves you with a lingering thought based on the sources you provided. If iFabric's in-house marketing actually proves successful, could they eventually just bypass these traditional big-box retailers altogether and pivot to a 100% direct-to-consumer e-commerce model?
Now, that would definitely solve the shelf space problem. It would be a fascinating evolution to watch.
Definitely something to keep an eye on. Thanks for tuning in, and make sure to follow the show for your daily earnings coverage.